All right. So, Jack, do you know about intuitive machines?
I don't think I've heard that term before.
Okay. So, it is a lunar exploration and services company. Stock I looked at today, their ticker is LUNR. And you can see my screen all right. Is that right?
Yes, I can. I can see it.
Okay. Yeah. So, yeah, this is the last 5 days of their stock price. And you'll see that it started to go down a bit. And then when the market opened today, it shut down over 20%. And so it's an interesting thing because it's another example of one of those companies that has a very long-term upside value because of its improvements. Because it's basically being a space exploration company, right? It's sort of a tech kind of investment where there's a lot of development right now. It's very state-of-the-art stuff, but the actual profit-making part is going to be pretty well into the future. And so whenever they have setbacks, it can be really bad for that individual company, even if space exploration in general isn't necessarily any less likely to occur, right? So I think it's a great example to look at, like, why, because I know that early companies like these will say were something you express as being interesting, but they're also very fraught with risk for reasons such as this. So what ended up causing the stock price to go down so sharply today is yesterday announced that their second lunar landing mission had occurred, but unlike the first one, which happened last February, and the when I say landing, they put a craft there, but there were no humans on the craft. It was basically a delivery mission to get certain equipment that they generally refer to as payload to the surface of the moon near its southern pole. The one they did last year in February was the first soft landing of an American craft since 1972. So obviously, soft landing is different than when they intentionally crash a probe and try to make something happen. We know that there's been some examples of that. But this is one where they carefully landed it with it intact, and they attempted to do a second one after the one a year ago went well. So they announced that it happened yesterday. But then today they came out and announced that it landed hundreds of meters off target from where it was supposed to land, and it was on its side. And because of both its location and its being knocked over, its solar panels were not positioned properly to collect enough sunlight that it would be able to recharge itself and continue to operate. So they had to conclude the mission very, very early. And it's not clear that any of the payload that they were delivering for their contract customer was deployed in a way that is salvageable, even if it's intact.
Really quick. Are you live right now?
I should be.
Okay.
Yeah.
Okay.
Yeah.
Okay. Good.
Yeah, I've got 13 viewers.
Send me the. You have how many viewers?
It says there's 13 right now.
Oh, good. Send me the link so I can get some more in here.
Okay. Let me see. Where would it be? It would be. You want the YouTube link?
Yeah. That way I can. That way I can see if I can get some more people in the in the chat.
Okay.
Yeah. Give it a booster.
Uh-oh, it's recycling the sound.
I got it now. Yep. Thank you. But please continue. So it didn't go very well. They were off target. And
Yes, and this is why the stock price had this sharp dip that you see here. So let's try and look at how this incident fits into their overall business model. So they have what they call three pillars of commercialization. There's their delivery services, there's data transmission services, and then there's infrastructure. the one that is really doing all the revenue right now is the delivery service. Basically, they can get things onto the moon for customers. Once they actually have things over there, then these other things become revenue opportunities. And so these are down the road. This is sort of their long-term plan, but really only the delivery is what's making money. And again, they had their first soft landing last year in February, and they just attempted their second. They've got two other missions in the queue ready to go. The next one, I believe, is going to start next year. So it's a very gradual process here. But the idea being, once they get through the bottleneck of their first landings and getting things on the moon, and they have things set up, it's easier to generate revenue from things like data transmission, from other assets that are just sort of operating and will be able to provide services to future landings there. It's sort of like a perennial feature. And those will be higher margin businesses. It'll be easier for them to turn positive cash flows. So that's why it's important, for them to get through this bottleneck and not have setbacks like this. So since delivery is what makes up most of the revenue, because look at what the size of this contract was. So they recently got a $116.9 million contract in September. So this is after the successful landing in February. So you probably have to figure that the successful mission IM-1 helped them secure the IM-4 contract. And so, if you look at what the year-to-date revenue has been, right, this is as of the third quarter. The fourth quarter and full year results are not out yet, so that they'll probably be out pretty soon. And during the earnings call, which I'm imagining will be sometime this month, management's going to have to talk about this. But if you look at the size of this contract for just one mission compared to their year-to-date revenues, they're mostly doing contracts with like NASA and the Space Force, just government in general, maybe certain private sector customers that just don't have these types of assets that are suited for lunar missions. But as you can see, this is 173.3 million for the year. So, if one of these missions goes poorly, I mean, this is a big deal here. And let's take a look here at the impact to margins, though, right? Look at how much revenue growth there was year over year. So, and if we look at the both the 9 months ending in September, as well as just the third quarter itself, right? We see that revenue is significantly larger. It's about 4 times as much revenue. And you look at how the operating margins improved, especially for Q3, right? Q3, revenues are up, but the margin is about half. So, it's indicating that there's room to scale here as they can get more contracts, get more things going. Eventually, they can get to a point of turning a profit. This is another reason why a setback like this is concerning, because you have to figure, if you're a customer, and you want to do this could be a wasted opportunity for you. Whatever money you as a customer put up, you might not be able to get back. A lot of these contracts as well have layers to them, so they realize revenue as certain performance levels or milestones are hit, and it'll activate like a next level of the contract. So that's the issue here. And one of the problems with companies like these that are in development phases, they're burning through money, and they have to get to a point where they start making money before they run out. So if we look at Intuitive Machines' financial condition at the end of the third quarter, because that's the latest report we have, they had about $90 million in cash. And then shortly after, because the stock actually did rally in the fall, they took advantage and used that to raise more capital by selling more shares in a private and a public offering. And between the two, they got about $104 million. So, based on what they were likely to spend in Q4, they probably have about $150 million in liquidity. And This is from their cash flow statement, so it gives you an idea of how much cash they're actually burning. So, last year, this is 2023, it was about $50 million for the first 9 months, and here you see that it's up to 60 million. So cash burn's actually increasing as they scale more, which isn't too surprising. That happens a lot when the companies are growing. They had to spend more to get the mission ready, and so it's not surprising that this happened. And if we look down here, this also shows more about what their balance sheet is like. So these are the current assets on the balance sheet. So if we just look at what the total assets are, it's 224 million as of Q3, and if you add 104 million to that from the offering, so that's about 328 million. Now, if you look here at their total liabilities, right, they technically have more in liabilities, and then there's this other port here. It's mezzanine equity, but basically it's a non-liability form of ownership that doesn't belong to common stock shareholders. So basically, the liabilities and the mezzanine equity combined are more than the assets. So this company has no liquidation value for common stock shareholders. So that's another reason why when there's a setback like this, the market gets really nervous and they sell off and cause like a 22% drop in the stock price. Is all this making sense so far?
Yeah. So what you're saying is like the average person is not really able to just jump in and short or play the market on this very easily?
I'm not saying that at all. What I am saying is that whatever the idea of the business is, whether it's an AI thing, whether it's a space exploration thing, these are all the things that will make or break them. It's what's their financial situation. So, for example, there was the quantum stock rally that happened in the fourth quarter of last year, and some of it continued into January a bit, had a bit of a rebound. And a lot of it has since subsided. Many of the quantum stocks are still higher than they were at the start of 2024 and have been pretty stable last couple of weeks, but at least compared to what they were doing in the fall. But if you look at some of the different quantum computing companies that were caught up in that rally, they don't have the same financial situation. Some of them have debt, some of them have no debt at all. Some of them have large piles of cash and they're not burning much of it relative to the amount of that cash. Some, have maybe a year and a half of liquidity before they will need to raise more capital. And so, raising more capital means you take on more debt, which means you could be bankrupt later on if things go badly, or it means you sell more shares, which doesn't make you go bankrupt. The company itself will keep going. But if you sell more shares, what does that do to the existing shareholders? They now own a smaller piece of the same company. So,
Right.
even if you're technically right about the whole company, that let's say it's worth $1 billion today, and it's a $20 billion company. Well, if there's also 20 times as many shares by the time it becomes a $20 billion company, because it kept having to sell more to stay solvent, do you go up 20x what you put in? No, you're basically the same, and probably with a lot of ups and downs in the meantime. Nothing like just the stability of having cash. And at least with the cash, you'd be collecting interest.
So I did a little research just now, and it said that it became public with a merger with SPAC.
A SPAC merger. Yeah. So a SPAC merger is basically a shortcut for investors to invest in a company before it technically goes public. So basically, there will be a shell company that's already public. It has a ticker it trades, and then for however long it takes for the actual company to merge with it, you can still buy the shares of the shell company. What will end up happening is they'll do something called a reverse merger, where the company with the ticker acquires the private company, the LLC, that is not public yet, but basically the company they acquire becomes the company with the stock ticker. So it's a somewhat recent thing that's been going on like the last 5 years or so. It's a way to basically raise capital because if you were to take your private company, which is usually going to be in the form of an LLC, the process to going public takes a while. If you can have a shell company that's already public, you can basically just go ahead and go to the public markets to raise capital very quickly and get that taken care of. For example, the Trump Media Company did that as well. And you'll notice if you look at the stock price history, you can see at what point last year the SPAC merger occurred, because there was a sudden jump in the share price after that happened. And so, yeah, these are the things that the SPAC merger itself, I don't think is particularly important for what's going on here. It's just it's just a process. The company's been around longer. It was founded in 2014, I think, and it just used a SPAC merger to go public. So that having been the case, what part of what this this equity here is sort of a residual of that. This is a non-controlling interest for the common shareholders. It's basically the shares of the LLC that are held by the original founders and investors. Technically, these are convertible to common shares if they want, but it has priority on the balance sheet ahead of the common stock. And since since it's not currently profitable, there's not much of a reason for them to convert that to common shares just yet. So the common shares, if it did come to like a liquidation event, they are on a lower order here.
Right. So you're saying that they're not profitable right now. So they're making 90 million. They're expending a little bit more than that. Is that the case?
That's not what I said. What I said is that they had about 90 million in cash as of Q3. So that's just what they had. That was in their bank account, basically. And because if you look here, what they're making, they're not making anything, right? Q3, they had an operating loss of 13.7 million. Year to date, that was about 44 million. If you actually go to the cash flow statement, year to date, they burned about 60 million in cash, because some things in an income statement are going to be non-cash items, positive or negative. For example, there's some depreciation here. There's impairment. These are non-cash, basically write-offs. But even so, it's this suggests that the look at the year to date. This suggests that the company only lost about $44 million. But if you look at the cash flow situation, it's burned 60 million. And so this is more important because the cash is what makes a business solvent. If they spend all their cash and run out, then they can't operate. It doesn't matter how many assets you have on your balance sheet. If you can't use them for something like you can cash, which you usually can't just swap assets willy-nilly. That's why they're otherwise they would be cash. So that's the issue there. So this is suggesting that they probably will use like maybe 70 to 80 million in cash a year at the current rate. Did you fall out again? Yeah.
Yeah, I did. Sorry about that. Yep. I'm back.
Yeah. So this is but this is suggesting that they'll probably use about $70 to $8 million in cash at their current state. They're an evolving company, so these things are subject to change. But this is basically telling us what the baseline is they have maybe, as of Q3, based on this, they had about a year of liquidity, we'll say, and they managed to raise another $104 million. So maybe they have about 2.5 years of liquidity, and that was when things were looking good, right? Because this lunar crash happened, one, some of the performance-based revenue that they were going to get from the contract won't happen now, and two, other potential customers might be hesitant to do contracts with them. So even if they eventually get some of this business, the fact is they're going to have to wait to make that revenue, right? And they've got a cash burn problem. So it's not helpful to their balance sheet if they have to wait to get money onto their balance sheet from revenue. And even if it doesn't make things go positive, we just got to look at, let's just say, they have about 190 million in cash, just based on what was here and the fact that they raised 104 million. in the fall through the share offerings they did.
Right.
Then, if they can make revenue, if they're burning maybe 70 to 80 million a year, right? They've got what 2.5 years. If they can make an extra 20 million in revenue, that slows down their cash burn. They might be netting about 5 million. What if they make an extra 40 million revenue in 2025, right? These things extend their window of time and make it so that they're in less of a pinch, so that they can keep going long enough that they don't have to take on debt or sell more shares and eventually achieve organic profitability and become self-sustaining. That's essentially the important thing here. So the reason the market reacted poorly is not just because it's bad news and some people were momentum trading, although I'm sure that was some of it. But there's an actual existential question that comes with something like this, right? So there's when you think about the long-term value of lunar exploration and being a first mover in that, long term, it's very easy to imagine it being a multi-billion-dollar company. I think when the market closed, the market cap of Intuitive Machines would have been about 1.5 billion. Is it crazy to say that sometime in the distant future, maybe 10 years from now, this will be a $15 billion company, so 10 times what it is now? I don't think that would be crazy, but John Maynard Keynes has that famous saying, in the long run, we're all dead, right? So you can say, economists and policy setters or investors or, people managing capital in a business are going to be focused on the long term, and they don't want to be too distracted by things that may only be short term in nature. But the reality is that you don't make it to the long term unless you survive the short term. Oh, see, Marcus. So this is one of those short term stress tests that is ultimately important to the long term, because they have to be able to land crafts on the moon and do it successfully enough that they can build up enough of a customer base, have enough assets on the moon that they can develop these other revenue opportunities. And that's not just from the performance-based parts of their existing contracts, but also because it will allow them to get more contracts. And then the more that they scale this, the better their operating margins will be, and they become profitable. So while, my point isn't that, the ordinary person can't really play the market here. I mean, they could have, but the real question here is understanding, why do stocks do what they do? In general, today, the market was down quite a bit for, what is considered a lot for the whole market. But this company had a 22% one-day price decline. And it's not very often that happens, right? If the whole market went down 22% in a day, well, that couldn't happen because the government has a rule saying that the market has to shut down if it goes down, I think, 10% in a day. They will make the market close early to prevent a complete financial collapse. And so, when an individual company goes through this, there's a reason for it. And when folks are looking at very forward-looking early companies that are doing something cool like lunar exploration, they just need to make sure that they're aware of what the situation is with its finances. Because if this company goes bankrupt, the shareholders lose, and what often happens in bankruptcy court is somebody just scoops up all the assets for pennies on the dollar, and it's a great investment for them because they're not having to pay the dollar; they're getting it for 5 cents on the dollar sometimes. A good example is if you want to really a tried and true example of this. Is Fruit of the Loom, the sock and underwear company. Warren Buffett bought that up in bankruptcy court, and he got it real cheap. And it's been a great investment for him. It generated a lot of cash. So he didn't buy the stock; he bought the whole company. Right? That's an important thing to keep in mind as well. He bought the whole company, but he was able to get all of its assets for very cheap because he was in bankruptcy court, and he happened to be somebody who was sitting on a big pile of cash that could pick it up. And so That's a thing to consider. They really may be onto something here. Their technology may be right, their market opportunity may be right, but if their own financial condition doesn't get them through it, then it doesn't matter. And that's what people who are investing in stocks have to deal with. They are not just tying themselves to this abstract future of what's going to be a good product, but does the company actually have the financial health to get to that point? This is why Warren Buffett typically only invests in stocks with companies that are already profitable, have little to no debt, because there's really no point for him to try and get creative when he can already find opportunities. But that doesn't mean that this isn't still worth watching. So anyway, my point here, the balance sheet is such that if they are pushed to their
Right.
limits, there's no liquidation value for common stockholders. And really, there's almost no liquidation value for the mezzanine equity holders either. So
it's kind of a risk. It's kind of a risk in the short term, but it could be a huge payoff in the long term. It's been from what I
right.
could tell, because I just did a little research while you're talking here, and so like just to throw out some stats to tell you what the way I'm thinking about it is. Okay, so this company is only generating approximately, it sounds like, less than 100 million a year, essentially. Am I correct about that?
Well, in terms of revenue, it's
Um,
generating year to date. It's 173 million.
Okay, that's
There's
pretty
no
good.
profits. It has no profits at all. It's losing money. It's never made a profit.
Right. But I'm just trying to think like on the long term. So by 2040 there's going to be there's estimated to be about $1 trillion of economic activity related to primarily lunar resource extraction, essentially. So
Okay.
if that's the case, 200 million would seem low as far as like what's 200 million versus a trillion. Like it's like what, 2% or something. I mean, it's if
Well, I
you
would
know
say there's probably a lot of people who'd be getting a piece of a lunar exploration market that size. I would say when you see a market cap, a good just starting point is if it closed at $1.5 billion. I think that's what it closed at. I may be wrong. It might be like 1.6. Not a big difference. But basically, look at that and imagine that's 10 times future earnings. So I would ask
right,
myself, if it's worth $1.5 billion, can I see this company generating positive cash flow, whether that's recorded as like the GAAP profit or if that's on the cash flow statement of 150 million in a year. That I could see happening. I think it would probably need to be able to get its revenue up into the billions before
agreed.
that could,
Yeah,
could be
I agree for
consistently
sure.
done. And so that's if it gets into about $1 billion, we're probably looking at a margin, somewhere in the low double digits at that point. And
Let me throw out a couple scenarios just while it's fresh in
Mhm.
my mind really quick, and just see what you think about the way that I'm just guesstimating as a layperson, right?
Mhm.
So here's what I see. It's like, okay, so it would need to get to about 1 billion to kind of start really making serious cash flow. And its primary customer right now is uh NASA, right? And then
Mhm.
and I think SpaceX has more of an edge as far as like near Earth stuff, and also Firefly Aerospace, right? So it's got some serious competitors. Obviously, SpaceX is the big brand name. What would be the scenario? What would the scenario look like? Like, let's say that in like 3 or 4 years, they start ramping up more like probes to space, and then like let's say that Elon decides, well, I'm looking for funding. I want to buy this company. If there was a merger, what would happen to all the money that people had already invested?
um, well, basically, if Elon through SpaceX or anyone else who might want to acquire them were to do so, uh, what they would do is they would just make an offering for all the shares, and they would probably do something based on what the market price is at the time, plus a premium of maybe 20%. So if it's $10 a share at the time, they might offer to buy out the company for 12. If it's $20 per share, they might offer 24, maybe 25, because that's just a finer number, right? That's often how something like that works. And then whatever the shareholders get is the proceeds of that sale if the board approves it. Sometimes there's a thing called tender offer where you can directly sell your shares to the entity making the tender offer, and that doesn't necessarily get them all of the company, but they try to get as many shares as possible for it. And then from there, the company might then do an acquisition deal for whatever's left over.
Got
or
it.
maybe if they get a controlling interest at that point, they don't
Yeah,
worry
and
about buying the whole thing. But
and the reason I asked that is for one reason. And sorry to interrupt you, but the reason I ask is like, okay, like if Elon is serious and Trump is serious about actually getting to Mars in the next, let's say, 20 years, I think that's a fair assessment, right? The moon would be absolutely critical to make sure that they can actually have a supply chain, right? So obviously, at some point, that would have to be a major thing, that they would consider, right?
Yeah,
And
I agree. I
you know,
agree. A moon base to support operations, not just to Mars, but throughout the solar system, it would become increasingly necessary. Plus, maybe any of the security factors that people are thinking of as well. So yeah, there's definitely going to be that coming into it, and that can always be an out for folks. But at the same time, um, people interested in acquiring the company might wait for it to go to bankruptcy court first. I think the only reason they want to do that is because they'd be afraid someone else will buy it first. But otherwise, it's also something where like they don't necessarily have to give people an exit with a good price. They can just scoop it up. Now, I'd say like in the case of Twitter, which Elon also bought, he did give them a good exit. Twitter shareholders got out at a very good price for what, considering what Elon paid. And that's a case where Twitter wasn't exactly in financial trouble, but it did have a lot of headaches with just, it's things about censorship and disinformation and the government,
yeah, and
trying
like,
to,
and probably
you know,
trying to find an actually reliable income stream, because I mean, I can't imagine what they were really making money from other than data, essentially. I mean,
yeah, it's
customer
just it was a lot of
data.
it was a lot of headaches. And for the board, I'm thinking it's a way for us to just get out, make sure the shareholders get a good exit price for what compared to what the money the business actually makes. So let's do it. But this is a different prospect. Is whoever acquires this business, right? If it's not making money for the business for the shareholders currently, it's unless the acquirer would be able to bring in things that make it run better. It probably is going to be a bit of a drain on the acquirer as well. And that's why, you can't necessarily bet on something like this. And then even a bankruptcy court play is tough because, if it's a bankruptcy court, the shareholders aren't getting anything. So anything good that comes out of it is going to be after the bankruptcy court decision, right? And then, you're not going to have advanced knowledge of that because you'd almost certainly be violating insider trading laws to have that and be able to act on it. So, yeah, that's what the tricky thing about this kind of thing is. But if we look here, like this one contract they have, it's part of their data services pillar. So you look here, they're basically illustrating, they can have assets that orbit the moon and then help transmit data across its surface as well as back to Earth. And so once these are up, they get to this point, it's a very inexpensive business to run that for cash. And this contract they have has a potential value of $4.82 billion. Right now, when you think about the contract size compared to the market cap, compared to the current revenue, that illustrates just how potentially large the growth opportunity is here. But the thing is, it's it has to be able to get to this point. And so I would characterize LUNR as a high risk, high reward investment. It can go extremely well, but it can also blow up in your face spectacularly. Now, one thing I will note that may be helping the situation, but we would need confirmation, is in February, they released an announcement, and this was when the share price was closer to 20, saying that all the outstanding warrants for their stock were going to be redeemed. Do you know what a stock warrant is?
No, I don't.
Okay, it's kind of like a call option, except warrants usually have much longer timelines, and they're usually done in special deals, as opposed to like call options are done on the options exchange. But basically, a warrant is a contract that lets you buy the stock at a certain price, and a call contract lets you do the same thing, but you do it on the open market. A warrant lets you do that with the company itself. And so warrants, if they're exercised, create more shares. And so if in this case they had 23.3 million outstanding warrants, which had an exercise price of $11.50. So what this means is that let's say the stock price is much higher, which at the time it's around 19.20. Anyone with those warrants could exercise them and go to the company and say, "Hey, we want to buy stock from you for $11.50. All right, so we're going to give you $11.50 per share, and then you're going to give us those shares." So it's creating more shares. The company gets some cash, and then often what people with those warrants would do at that point is just sell them on the open market while the price is still high. There was a clause in these warrants that basically said, if the stock price is above I think 18, the company is allowed to redeem the warrants and give 30 days notice. And basically they could redeem them for pennies on the dollar if the people holding the warrants did not exercise them. So they gave that 30-day notice about they gave it about 30 days before this happened. So it was done, I think, on February 5th, February 6th. So, almost a full month. I mean, February is a 28-day month, I guess, but almost a full month to do so. And we still don't know whether or not that was done. So, like if people exercised the warrants in that time and decided to just go with it. So if all of them were exercised for $11.50 a share, that means the company could have raised another $268 million, right? Now, if we assume they had about $190 million, right, this is significantly more than that. So they may actually have a few years of liquidity here. And that, if this is the case, even though it will have diluted the shareholders a bit, it does mean the company is not in as near of danger as complete failure. It might actually have just enough liquidity to maybe get a few more missions through, have them go successfully, rebuild its image after this one failed, and then be back on schedule to do that. So these are the things that will be important to listen for when the Q4 earnings come out, because management does conference calls with analysts, and the analysts will ask questions like these. So those are the things I'll be listening for: is how much cash do you have currently? Like, how much did they spend after they raised the 104 in Q4? How much did they get from basically forcing the warrant holders to exercise their warrants? And has this incident affected their talks with other potential customers on contracts? Are there people who are not willing to sign contracts now, or do they want a lower price on the contracts? Like, what's happening as a result of this stuff? So those are the things I'll be looking for. But if you look here about where the price was when they, said they wanted to force it, it was here. It basically for the next 2 weeks was above the level where they can do it, and then it started to go down gradually. Now, it may be the case that people started exercising, they got their shares, and then they started to sell them while they were above the 11.50, because it's a profit at that point. And it wasn't until basically this bad news came out that the price fell below the exercise price. So anyone who exercised those warrants and got shares for $11.50, well, now their shares are less than what the exercise price was. So that's the potential issue here. So that's the situation with this stock. So it's not something I would buy because I don't want high risk, high reward. I want low risk, high reward. I want that favorable asymmetry. And I don't think Intuitive Machines is at a point where that can be said yet.
Yeah, I agree. I was looking at some of the analysis that I pulled up, and I would say that like I think it's at 11.26 or something, right? Or somewhere around there, 11 something. And I guess the ultra positive, would be somewhere around 24. I would say like 8 or under. I might gamble a little bit, but I definitely wouldn't go above $8 or personally. Like based on what I saw, like I think if it goes below $8, I might buy in, but I wouldn't buy
Yeah, well, the thing about
above
price
that.
is you can price away some of the risks, or you can get rid of some of the risks just by price, right? So, if it goes down to like $2 a share, the risk is significantly less. Like if the liquidity is the same, let's say it did get the $268 million in cash. If it's got that, and you can get it for $2 a share, you're getting a very good entry price for this long-term value. Now, some of the issue is I think it would be the latter half of this decade before the company would really start to see that in its own cash generative, self-sustaining ability. So
Yeah,
you still have to be extremely patient with it.
yeah, I
And you
definitely.
might,
Oh, go
yeah,
ahead. I was just gonna say I definitely think that under 8 years, you're not gonna really see like a huge return on your money for
yeah.
sure. Like, yeah,
And so whether you get it $2 or $8, it's very possible that you could just see it go flat, and then when things finally go well, boom, it just shoots up. And that's what happens with a lot of these early or development stage companies. And of course, it could be extremely volatile. It could just be all like this between 2 and 8, and then if when things get to the point where things are going well, it takes off. It goes to 40 or 50, and then all those fluctuations between 2 and 8 that seem like everything seem almost insignificant by comparison, right? Um, so, but we still have to see because it's earnings season. They haven't come out with their Q4 or full year results yet, so that'll give us an updated balance sheet. And even though the cash they raised from the warrants is technically in Q1 of this year, and therefore would not be on the end of year balance sheet, management would still be able to speak to how much cash they have during the conference call. It's not unusual for them to say, well, here are how some things are going through Q1 since we're halfway or even almost all the way through Q1 right now. Like we have this much in cash roughly. And so if they're like, well, we have like $100 million in cash, that's not a good sign. Because, between the equity offering they did and the fact that they probably should have gotten a lot more from those warrants, I would hope that they're sitting on at least $300 million in cash right now, and they have a few years to get through.
yeah. And I was just taking a look. Like the other thing that was on my mind was to look at like what Trump has done since taking office. So he appointed Jared Isaacman, a billionaire and private astronaut, whatever that means. And he's kind of affiliated with SpaceX, so he may be more friendly with SpaceX. But again, like if SpaceX's goal is to actually, try to get to Mars, then essentially that would be in this company's favor in the long term, at least. So I guess it depends on how fast do they want to hit the gas pedal with all
Yeah,
these savings that they're doing by cutting the government. And that actually, I mean, to me, I'm not a huge Trump person or anything, so like my opinion's not like biased, but I think that if Trump and Elon are serious, perhaps they're doing all these cuts to reorient the economy towards quote unquote green energy and space exploration. So that could be a reason why they're doing all this up front to say, well, we're gonna revamp the entire economy towards space exploration, which I kind of think is a smart move because at least it gives America something to focus on other than war and stuff like that. So I mean that could be a positive thing, and I think it's going to depend on how is the public going to react. And thus far, as much as people seem outraged at Trump, I think that in general people are looking for a positive direction. So I mean, I think that is kind of, I feel personally optimistic, but again, that's just my feeling. But so he did executive orders and budget signals. So let's see. I'm just seeing if there's anything specific. Let's see. They may propose slashing NASA's budget, possibly to 50%, to redirect funds to defense or tax cuts, but that hasn't been confirmed. So, Artemis, I don't know what exactly Artemis means. Do you know what the NASA's program Artemis is about?
No, I don't.
I got to look that up. But so basically, there's some sort. I guess that's a primary thing about the lunar thing. So it's something related to. Let's see. I'm just seeing if there's anything else that like really stands out. Sorry, excuse me. Just double checking. Commercial crew. I don't know. I think it's really up in the air right now, but perhaps I'm pretty sure if they do come out with some sort of major news about space exploration, then that'll be good. I do think that if Elon is to be believed that he is very set on Mars, so if that is if there's any truth to that, then there's definitely a high likelihood that between him and and also you have to remember people like Bezos and some of these other people are very big into it. So it's not.
Mhm.
It's probably going to be a concerted effort between a lot of major business people, I would imagine, and also a lot of the people in the Middle East, like Saudi Arabia and UAE, seem to be favoring America as far as this kind of stuff is concerned, rather than like Russia or China, as far as it looks like. So I don't know. I think those are factors that I would consider. If something moves on those ends, it might change the outcome, of course. I don't know. That's just
Yeah,
my thoughts on the brief stuff.
things are very uncertain in the near term with the federal government. I mean, there's a lot of talk now of balancing the budget, and it's difficult to see a particularly expanded budget for lunar exploration and private companies getting those contracts when the talk right now is on not only cutting spending but also cutting taxes while they do it. They're going to have to cut a lot more spending than they cut taxes for that to work out. And near term, I don't know what that looks like. Maybe they don't cut NASA, because NASA hasn't exactly been getting a lot of funding in recent years. Anyway, I remember that being a thing during Obama. People talked about how neglected and underfunded NASA was, and it's a part of the reason why there are so many private space exploration companies, is because there was a void left by NASA, and so the private sector began to fill it somewhat. So hard to say, and it's not clear even if that happens if if spending not only occurs but it's accompanied by tariffs. The odds of a recession seem much more likely, and markets of course sour on that, and so companies that aren't even technically profitable yet, it's difficult to imagine their stocks doing pretty well. And I figure a lot of folks who might be buying Intuitive Machines stock today, with the hope that it like I said, NASA gets 70 million a day, totally underfunded. The screen is black.
Did you want to look at the Enix stock or anything else? Because I have a couple PR firms I wanted to look at if you're wanting to look at anything else today.
No, I don't have it. And also, we're coming up on an hour now, so I think we should probably wind down and just, if there's another stock, we can save that for like a later stream. And it says the screen is black. Well, I'd like to fix it, but
Sounds good.
Maybe it says can't post comments on this. I don't know. All right. Well, but yeah, did you have any other questions about Intuitive Machines, Jack?
Not off the top of my head. I think I looked at a lot of stuff, and that was all the stuff that kind of stood out to me. So.
Okay. Cool. All right. Well, yeah. So it was good talking about this with you. I'm glad I could sort of show you an example of a company being tested. Interesting. There's been nothing on screen today. gonna have to look at what the issue was there. Okay. Well, thanks for letting me know, Lonza. Jack, it was good talking with you. I'll show you some more about some stuff about the stock you have in mind. Just message me. Okay.
Will do, and hopefully we can ramp up, do some more of these kind of things because I'm starting to get a little more of the hang of like some of the stuff to look for. So I mean, slowly, but I'm I think it's going to be more and more interest, more and more. I can do a little more research beforehand, hopefully, so try to find some more teachable things for myself.
Yep.
And others. Yeah.
All right. Cool. Well, I'll catch you next time, and we'll chat in the meantime. Okay.
All right, sounds good. Thanks, Joe. Bye.
See you, man.